Morning. Thanks for starting your day with us. This is the market right here on ET Now. I'm Avan Dabash, and with me Nikunj, Dalmia, as well as Aisha Faridi just joining in. Let's get you a sense as to what the market looked like in yesterday's trading day, because clearly it looks like we've hit the pause button. 3 straight days on the trot that the Nifty was under pressure, and this after all the rah-rah of 20K on the screen. So it clearly has wiped out something like 5,500 lakh crores in terms of the overall market cap. And it's been the large caps that have really borne the brunt of this sell-off. Take a look at the constituents: ICICI Bank, Reliance Industries, HDFC Bank, which has been an underperformer of late. Those continue to weigh down heavy on the markets. And interestingly, it wasn't just regaled to the frontliners, because the broader markets too felt the heat, a sharper fall being witnessed for the mid and the small caps. So what exactly does this indicate, Nikunj, that we've hit the pause button?
Yeah, pause is the right word. It is, I don't think it's a retreat or reversal. Those are very sharp words. It's just a pause after like a linear move. This is a combination of what is happening in the global markets. So I think large cap stocks in a sense have hit a pause button largely because of the global narrative, where Fed has changed their outlook on the US economy. Bond yields have inched higher, and we've seen a smart comeback in the dollar index, which is now north of 105. So to understand that why markets have hit a pause button, that's the data. That broader market have seen a sharper sell-off, Nifty has retreated. I think this is largely got to do with global markets. In the mid and the small cap stocks, I think an overdue correction was, overdue. They had become fat and obese. And I think from some mid-day turbulence, some skim from the top, I think is clearly expected. But my sense is that this is more like a pause. If the correction is going to be there, it's going to be very shallow. Market valuations in large cap stocks are not very expensive. Mid cap stocks, well, they may take some time before they find their feet, but it is nowhere any kind of an indication that the bull market in India is over. Imagine a tree which has some weak fruits, weak leaves, ripe fruits. Yeah. They're just ready to fall. Yeah. And I think this kind of a shakeout will only give good entry points to real genuine investors who've been sitting on the sidelines. So any bull market, all bull markets, they correct, and this kind of a skin from the top, I think, is very healthy.
Yeah. And that's exactly what we've been seeing also, right? The way banks are coming off. I mean, the fact that the Nifty Bank is now 140 points away from its 100 DMA. It's topped twice near that 46,350 odd level, and it's a good 4% away from the highs. And the kind of systematic selling, if I can call it that. It started off with HDFC Bank post its analyst day. Yesterday was ICICI Bank. And I mean, who knows, many others could follow suit, which they already are actually.
See, you can divide banking space into pocket of momentum and pocket of value. I think the pocket of momentum is clearly there in the PSU, mid-tier PSU banking space, where we've talked about it, that how the smaller PSU banks are moving higher like a rising tide phenomenon. But within the large cap banking space, I think not me, just everyone is surprised that why banks are underperforming. You can attribute to the over-ownership, the recent bout of outperformance which happened in 2022. So banks are underperforming. But if there is a pocket where you can say that for next 2, 3, 4 quarters, there is reasonable amount of visibility, some degree of valuation comfort, institutional appetite, and a great bet to really bet on when it comes to India's earnings growth, I think banks really make that cut. So I think the downside in banks will not be very pronounced. The downside in banks would be gobbled up by investors to buy into banks. There are technical aspects which are always at play in the short to the medium term. But if one is looking at a place where there is reasonable amount of comfort, visibility, valuation are on your side, I would say large cap banks for sure. They may have underperformed and they may underperform for next couple of days. Who knows, because of liquidity and because of the current leg of decline. But I guess if you want to be a buyer on bad days after a bad patch, it really would be banks. See what may happen, Aisha, if you go below technical levels. The bank Nifty is supposed to be in heavyweight, and it may have its impact on the market action purely because of the size it has. But if you're taking a 6-month view or even a 1-year view, I think banks at low levels after the time-wise correction and the valuation of comfort, I think is something you need to rotate your money into, not out of.
Okay, just a quick summary as well as to how the global markets were trending overnight. It was a 3-day losing streak for all the three averages, and clearly reacting to the signals from the US Fed Reserve that interest rates could be higher for a longer period of time. Asia, it seems, as well, is piggybacking on that decision, as well as the Bank of Japan rate decision. So barring Hong Kong and Shanghai, everything is in the red. And the GIFT Nifty indicative move as well is down about two-thirds of a percent. But let's move on to the other talking point then. And JP Morgan has also said that they will include India in their widely tracked emerging market debt index. And that really, Nikunj, is going to set the stage for billions of dollars of inflows.
See, this in a sense is one of the most anticipated news. Markets knew it was coming. It was, you didn't know when it was coming. There has been a lot of back and forth which has happened within the ministry and within some of the brokerages who wanted certain clarifications. But I think full marks to the government in this case, where they have ensured that whatever concerns were there, those concerns have been addressed, and now JP Morgan has included India as part of their bond portfolio. The implications of this, I think, for the bond market are going to be very profound and very large, simply because it means that at a global level now, because just like MSCI index is used by equity investors for benchmarking purposes, JP Morgan and other indexes are used by the bond investors. India's weightage now could go up to as high as 10%. That means starting from June 2024, we are looking at inflows coming into the Indian bond market. Of course, the concentration would be spread across 8 to 10 months, so it's not going to be having a real impact on the bond market per se. But this is something which now really opens a complete big window of flows into the debt market, more dollars coming into India, and I will not be surprised that this will just add more liquidity to the system. Just think about the setup. If you look at the macros of India, which is the fiscal deficit, the twin deficit, the way the earnings are moving, our forex reserve, the macro concerns in India have got diluted. The yields in India are north of 7%. So really it's one of those, this is something which should have happened earlier, but now it has happened, and this is something which will have profound ramifications, at least on the bond market, both in terms of inflows, liquidity, and option for investors to come into India.
Oh yeah, absolutely. In fact, on that note, let me also take it across to Vinny and find out what the global commentary has been overnight. Vinny?
Good morning, and today we're going to start the important commentary that is coming from Peter Schiff. Now, he's highlighting in terms of the bond yields as well as the soaring yields that are actually bearish for the dollar. But yes, they are bullish for the gold. Now, he highlights specifically that the sharply higher interest rate that could cause the US markets to actually weaken further, the economy to weaken further. And, already that deficit is there in their federal budget as well, which will furthermore swell up because of these issues, and that could likely cause, in terms of the fears that everyone is talking about, the recession that could be there, as well as a financial crisis, as well as a return of the QE as well. So that are the concerns that he's highlighting on in terms of the higher interest rates as well as the soaring yields as well. Now, in terms of the next commentary we have it from Mohammed El Arian. Now, he's also highlighting in terms of the highest US yields, including the 10-year yields, which is also nearing that 4.5% mark, are a bit of a problem, not only for the US but also for the rest of the world. And he's highlighting specifically that they could complicate matters for Bank of Japan in terms of the YCC exit and intensify the balance payment pressures facing for the developing countries as well. The next commentary we have, that is coming from Lawrence H. Summer, and this one is in terms of, he's talking about Fed, and they believe that he's saying that Fed is trying to make that soft landing, but there could be a surprise coming in for them. And he highlights the risk that is also there, including in terms of the auto strikes and the unions that are pushing, says that push by the unions could actually have a major implication on that as well. So let's keep an eye out on these important rate hike decisions that are made by the FOMC. This time there was a pause, but what happens ahead is something that is concerning most of these commentators as well. Moving on, we have ECB's Stornorus, who's talking about, that ECB rate hikes are likely to be at a peak for the next few months, but doing too much could be a big risk, and ECB has reached the peak rates. Next move likely could be a cut as well. BOE's Bailey is also highlighting in terms of, it's actually premature to start talking, is what is highlighted in terms of the rate cuts, as well as good news is that inflation in the UK is coming down, and they are going to stay on the course to fight the inflation as well. So those are the key commentaries that we have coming in this morning.
Okay. Now let's look at the mid and the small cap space and what's happening there. Discuss banks. Let's discuss the mid and the small cap space, and especially PSU banks and defense stocks. What a reversal we've seen them. And I'm purely talking about not the companies here. I'm purely talking about the price action here. That's the Nifty PSU Bank Index. It had a breakout last week. Now it has reversed completely. Similarly, if one looks at the intraday graph of UCO Bank, IOB, sharp reversal in, there you go. From the recent high, Central Bank is down 17%, Punjab and Sindh Bank is down 17%, UCO Bank is down 14%, Bank of Maharashtra down 13%, and Union Bank is down 7%. Union Bank is a much larger balance sheet, so it does not come in the same cut. But if you look at the first 4 companies, they have 2 or 3 things in common. One, the price appreciation from the recent low has been nothing short of extraordinary. B, the government free float in some of these stocks I think has been very less. The government ownership is very high. These are non-institutional dominated stocks and they are trading almost equivalent to their free float with low delivery. Bottom line here is that some of these small PSU banks, I think they had become very obese, and purely in terms of price correction, the price correction was around the corner. So I'm not at all surprised with yesterday's price action in some of the PSU stocks in terms of where market action is, what market's indicating. While I think banks, you got to be with banks, but not this space, not small PSU banks. Right now the comfort I think is with only big banks.
Yeah, and also, you know, to the point about those frothy spaces within the mid and small caps, we were just looking at data as to how much railway stocks, for instance, the much fancied and frenzied space in the market, how much they've actually corrected from the recent highs. So look at in Nircon, that's fallen about 23%. RVNL Nikunj is down 20%, so is IRFC. RITES is down 15%, and 11.5% fall in IRCTC. And even Titakar Wagons is down about nearly 9% from the recent highs.
This is pure price. You know, we are right now looking at the price action. We are not looking at, oh, you know, whether the sector is good or bad. I'm purely looking at the price action here. I think I'm completely synced with what the general consensus views, that railway, I think, is a multi-year trend. The government capacity is increasing, and there is an incremental change in the way how some of the railway dominated businesses would move. We are purely talking about the price action here. The price action in RVNL, IRFC, REITs. Look at the price change. My limited point here is that in markets, sometimes prices, they get discounted way ahead of what the actual earnings delivery would be. Sometimes it happens afterwards, sometimes it happens before, and sometimes you fast forward to next 2 or 3 years. So in some of the railway stocks also, markets have started discounting FY27 and FY28 earnings. While you will reach there in terms of what market projections are, what the assumptions are, where the sector is moving, I think in general, some of the stocks were due for a correction, and not at all surprised, not me, nobody surprised that the correction actually has kicked in. But you still want to wait it out, Aisha, to buy into them. You want to be a buyer in some of the railway stocks, but at not these levels. I think the correction has just about started. I expect them to get into a time-wise correction for some more time, and that's the time you want to start buying them. Let these stocks settle. The time to buy is not the first fall, but time to buy is that when the stock, they move into some kind of a time-wise correction.
Yeah. Okay, we'll talk about all these spaces and the kind of, skim from the top that's happening and the churn that's taking place across the board pretty much. In fact, on that note, let me take it across to Kush, Bohra as well as Kunal, Bothra too, and try and understand what the trading texture is looking like. And Kunal, quite a bit of fall, right? Almost on a daily basis, we are giving up those, round off figures on the index. And yesterday was 19,800, just about defended actually 700 there.
Yeah, it's a very sudden and a sharp reversal for the index. Very difficult to comment the reason behind this kind of a sell-off. But then when you look at the market internals, I think one thing is certain that it's come out as more of a surprise for the markets. Now, one of the data which we flagged consistently over the last couple of days is the drastic drop in the open interest for the bank Nifty, which means over the last 5-6 days, the market participants were anticipating some sort of strange price action on the banking index, and I think from there on we've seen a reduction of almost 50% in terms of open interest. Now, interestingly, yesterday on closing, we saw a 23% jump in the open interest for Bank Nifty, which means that we could now probably settle into this range of 44,500 as a pivot support for the index, maybe 100 points, 200 points plus minus that support for the banking index. So I'm expecting that hopefully by today, tomorrow, we could probably expect the markets to stabilize at this level. But the impact of the selling and the two gaps which have been created on the downside in the last 3 days indicates that on the way up in terms of a bounce, you would probably see a lot of resistances for the indices.
Let's find out what Kush Bohra's view is as well. And Kush, interesting that we were mapping out the underperformance within the bank index, the fact that the Nifty bank has fallen below its 50 daily moving average. What is this indicative of?
First up, good morning, guys. Thank you for having me on the show. Well, one word, springboard. If the Nifty has to move to 20,300 and 20,500 kind of levels, by Diwali, and Bank Nifty has to sustainably move above 46,000, then this is a good platform that we are seeing, set in. I was listening to Nikunj talk just a while ago, where he was saying everyone is waiting, and everyone was waiting for the dip to come in. Well, it has sort of come in now, right? So it's a good time to start accumulating these, stocks that you've always had on your radar, at least off late, but you weren't getting a good entry point. Now the entry point sort of being created. So as we generally say, don't buy the dip, buy the first bounce, and that's the kind of confidence we have in the market, that the first bounce, even if it sort of seems like a dead cat one to begin with, I'd go out and buy. So I will perhaps just wait for the Nifty to settle. I agree with Kunal that maybe a day or two where the markets will perhaps try to find its feet. But once I get that base where it looks like the near-term fall has sort of stemmed, I will actually go out and buy some of these names. As far as Bank Nifty goes, you're right. But the kind of springboard action that we'll see here will actually be more encouraging than compared to the Nifty. So I'm actually looking at 45,500, 46,000 kind of levels on the Bank Nifty, by the next expiry also. So I'm looking at some of these falls from a very optimistic standpoint. On the whole, I am not too discouraged by the kind of dip that we are seeing. This is just probably an opportunity. Probably a couple of months down the line, this will probably turn out to be an opportunity missed if someone doesn't enter at these levels.
Okay, fair enough. Let's nail it down to some stock-specific calls as well and find out what our chartists are picking out for the day. Kunal?
So I'll go with a mixed bag, one buy and one sell. The sell is on PI Industries, something we discussed 2 days back. The stock showing signs of weakness at 3450 odd mark, would maintain the targets which I had given for PI Industries at 3,400, and expecting this weakness to continue for at least another couple of days, and stop loss could be trailed to 3,500. And Adani Ports apparently is one of the stocks which is actually showing signs of strength. So would go for a contra buy on Adani Ports. The stock showing signs of a slight bullish candlestick pattern. So I'm expecting a follow through over the next couple of days. 860 as a target for Adani Ports, stop loss at 815.
All right, there you have it. That's what Kunal's strategy is for the day. Is it a similar strategy that you're adopting, Kush? What is it that you're looking at by way of individual stock calls?
Slightly more optimistic, although I concur with Kunal's call on Adani Ports. It's something that we have on our radar as well. But the two stocks that I have on my radar immediately are UPL and Gati. Now UPL has actually sort of completed its fall way before the market started dipping, and it's showing signs of strength. Even if you look at the recent dip, it's not really participated as well. The most of the dip had already come in about a week, a month or two ago. So from here on, the stock seems to have a very limited downside. 640 and 660 are the near-term targets that we're looking at. 610 is where I would place my stop loss. Similar view on Gati. The stock's gaining from strength to strength. Even in the recent dip, the stock's not even touched its 20-day moving average, which is a very encouraging sign again. So 172, 178 are the targets that we're looking at. 159 is where I would place my stop loss. So UPL and Gati are the two stocks on my radar.
Okay, let's shift focus from what the charts are indicating to the most talked about sector in the market right now. That's defense as well as PSUs. In fact, hear it out from top market experts, Atul Suri as well as Gautam Duggad, and their individual views and opinions on this particular space.
What's surprising me is that after a phenomenal 22, they're also having a very good 23. And that really shows that, yes, when decadal trends change, it doesn't end in a year. It actually gets elongated. In fact, the whole PSU basket, if you see, it's not just banks, it's defense stocks. It's a lot of these, infra kind of plays. These are like everyone, people who've been in the market for 20, 30 years have sworn we'll never buy PSUs because many times in their life they tried and they burned their fingers. They've given back 40, 50% drawdowns that have happened.
If the policy momentum disrupts in any way, irrespective of what is happening to their business, if there is a policy change, then the PE multiples can crash.
Okay.
Because they're end of the day government entities. Their working capital balance sheets are very different because their biggest customer is government. Second, if for whatever reason the execution suffers, a lot of things have to fall in place for execution to materialize. So even if the policy momentum is supportive, but execution is not supportive and execution falls apart, then there is a possibility of a crack.
All right, let's move right on then and revisit the story about JP Morgan, looking at the bond inclusion for India. We've got Shogato Bhattacharya as well, who's now joining us on the phone line to give us his take on the same. Shogato, just wanted to understand what exactly this would mean for India, given that now this move is going to really set the stage for billions of dollars of inflows.
Yes, hi, good morning. Thank you for having me on your show. Yes, this is fairly big news. So JP Morgan, I'm hearing that market analysts are expecting inflows of around $30 billion. $30 billion is a large amount of money, say almost 3.5 lakh crores. And remember, for context, that this is going to start happening in FY24. So assuming that net government bond, the center's issuances, is around about 11.5 lakh crores, and the 3.5 lakh crores that is likely to come in over the course of say 12 months or so is a fairly significant amount for this total issuances. And remember, this is just the analyst flows, and these are just passive flows that funds that actively track these indices. This is the amount of money that is expected to come in. On top of that, there will be significant active flows. That is, people anticipating the drop in yields, interest rates, will try to bring money in. So we can easily see inflows of $40 to $50 billion. In fact, it might be a problem managing this amount of inflows coming into the system. But RBI has shown that it is very, very adept and agile in managing interest rates volatility. Remember that India is a very attractive. India bond markets, fixed income markets are very attractive because our yields are relatively high. Our rupee is a very low volatility currency. Right. So it's a very attractive market for foreign investors to invest in.
Sure. Shogato, just picking up on the point that perhaps you were hinting at, whether the Indian bond market is deep and mature enough to handle these kind of inflows right now, while the RBI, of course, is confident.
It is. The Indian bond market, the outstanding is very large. The outstanding is of the order of 180 lakh crores. So, I mean, it's one of the largest bond markets amongst emerging markets. So I think it's the fourth or the fifth largest market globally in terms of primary issuances. Of course, secondary market volumes are relatively low, but even that has increased very, very significantly over the course of the last, say, 10 years or so. So it is possible to handle. I mean, this is not a difficult issue because remember, the good news, the even better news amongst all of this is that banks hold a significant amount. I think about 40 to 45% of the total holdings of securities is held by banks. Now, if this gets transferred over to foreign institutional FPIs or other bond investors in the market, this opens up the balance sheets for banks, insurance companies, etc. So that will provide them incremental room for lending to corporate debt. I mean, corporate credit or corporate bonds, etc. So this is large ramifications outside the immediate the government bond market. So this is significant ramifications. So I think it should be possible to handle. RBI will probably have to support such a move by bond buying, etc., which is another area where interest rates are likely to come down. So this is a fairly significant move, yes.
The other point that, Shogato, you're making, the kind of ramifications and repercussions that it has for the universe at large, what would it really mean for, say, the cost of borrowing for corporates and banks?
So, well, I mean, it's difficult to say that immediately. When the market opens today, we'll get an immediate sense of how much the benchmark 10-year government yields, which are now trading around 7.717%, what the immediate implications are. But this say of the total issuance size, if one third is a new market that is opening up, bond yields can fall I don't want to get into numbers, but easily 30-40 basis points. So to bring it around, say 780, 680 or so, 6.8%. In addition to that, remember that at some point in time in FY25, the next fiscal year, we also expect RBI, the MPC, Monetary Policy Committee, to start cutting rates in line with global rate falls. So even that will have an impact. So the two together, this additional set of investors who are coming in, 30 billion, 40 billion of investors, and on top of which we are expecting rate cuts. So this is likely to have a very significant impact on bond yields, which will have other problems as well. To manage this volatility exactly as you mentioned. So the role of the Reserve Bank will be very significant. In addition to that, whatever the government of India, the Finance Ministry does in terms of managing the issuance, the program, are likely to be required as proactive measures to control this volatility.
All right, stay on with us, Shogito. I would also like to bring in Mr. K.K. Mistry to get in his views and thoughts on the same. Thank you so much, Mr. Mistry, for taking time out and joining us on ET Now. First off, let's get in your thoughts on this news and what exactly do you believe the impact is going to be on the Indian bond markets?
First of all, I think it's a fantastic thing from our perspective. It's something we were expecting about 7 or 8 months ago, and for some reason it didn't happen at that point of time, but it's never too late. It shows India's power, India's increasing importance on the global stage. We are, after all, the fastest growing economy in the world. So my sense is by inclusion in the JP Morgan index, we can get about $25 to $30 billion coming into India through this process over the next 12 months, once it starts. So it's good for the economy. It's good for the foreign exchange reserves. Our forex reserves, as you know, were at one time nearly 600 billion, and they came down to about 550 odd billion a few months ago. But in the last probably 6 months or so, we recouped all that losses and we come back to a reserve position close to 600 billion. So this would only further improve that.
So, Mr. Mistry, do you think Indian bond market is deep enough and mature enough to deal with this volatility?
No, I think it's of course, Indian markets are mature enough to deal with it. I don't think that is an issue at all. And obviously, this means this is a huge opportunity because it will make borrowing from overseas that much easier, that much more cheaper.
So, will this take away the entire sheen from the dollar bonds and the impact of this on the rupee?
So clearly, this will bring down the yields, at least as far as the borrowing from overseas is concerned. It's too early to say how much their yields will come down, but I think you will see the effect coming through almost immediately because the markets will factor that into account right away. And clearly, if you are a company looking to borrow money from overseas, this is a great time once India gets included. The actual process starts, which I think is from June of 24. Now we have one more index if we can penetrate, which is the Bloomberg index.
All right, Mr. Mistry, really appreciate your time and thank you for joining us. Okay, I'll tell you what, Mr. Mistry, if I could request you to stay back, have to ask you a question on HDFC. But before I do that, Shogata, let me get closing comments from you. Now we can compare the forex reserves of India and say, okay, it's about $550–600 billion. Bond inflows could be $330 billion. Mathematically, it's right. But in theory, it will not work like this.
No, you're right. Absolutely. That this is difficult to manage. I mean, a concentrated inflow of $30 billion coming into the markets. But remember that this is not. We've seen FPI flows into equity over the last, say, since April of this year, of exactly $30 billion, $35 billion. So the markets have absorbed it. I mean, and this is despite a significant volatility in the dollar, in the Chinese yuan, in the RMB, CNY currencies. So the markets have absorbed it. So RBI will have a large role to play. And I believe they have the room in the forex reserves, as you mentioned, $600 billion. To add $630 billion to be able to absorb this, the RBI will obviously have a large role to play. But then overall, say the bank deposits will grow at say 10%. Out of that, you have a 18% SLR requirement. So even that will allow some amount of this inflow to be held by banks. And there are the other large holders, the provident fund companies, the insurance companies, etc., who will also be able to draw a significant amount. But I agree that this is not going to be very easy. It's not going to be a simple process. But I think the RBI, in coordination with the government, have shown that they're able to manage inflows like this. So I don't think this is an extraordinary situation, but this is very beneficial for the entire interest rate regime in the country.
One final question, Sugata. We are starting with JP Morgan. I'm sure Bank of America, Merrill Lynch, other brokerages also would be having a similar kind of a thought. So the $330 billion what JP Morgan is alluding to, is that their index or this is the universe which they are referring to?
I think this is their index. Remember, there are three major indices: the JP Morgan, the FTSE Russell, and there's the Barclays index, Bloomberg Barclays index. So there are these three indices. So this is just the numbers that we are talking about, 1% addition to an additional 10%, that works out to approximately $30 billion. But their holding, I think, is about 230 something billion dollars in the index. The bond holders who participate in this index.
So I don't want to jump on any kind of a conclusion here, but what you're telling is that it's like early Diwali, early Christmas. Everything has come early for the bond market, because the bond market in the run-up to the actual inclusion will start factoring this in.
Completely. I think, this is always a forward-looking, expectations-driven market. And remember, this is not just the bond markets. This is going to have a significant impact on the equity markets as well. Because the first thing is that interest rates coming down is a growth driver, and growth driver meaning you are the expert. So equity indices.
Okay, Sugata, appreciate your time. Thank you for joining us. Keki, thank you for being patient. I'm sure you're aware of what happened to HDFC Bank stock last couple of days after the analyst meeting. I'm going to skip my mandate, but maybe try my luck. A word on that analyst meeting?
Well, I think the requirement for funding, India is growing so fast, and the requirement for funding is so huge that I don't think anything is going to, any option is going to go away. But this clearly will make Indian bonds very attractive from the perspective of global investors, and it should bring down the yield for India. And more than that, it will also bring in foreign exchange into the country. So it would have a ramification and impact on the rupee. The currency can strengthen. Having said that, obviously a lot will depend on RBI's action, how they deal with the dollars as they keep coming in. But it would result in appreciation of the rupee.
We tried our luck, but thank you so much for giving us your thoughts. Good to have you on board then, Mr. Mistry. Let's listen into then. Let's take a very quick break and we'll come right back with lots more stock ideas. Welcome back. Okay, let's get stock specific then. And the ET Now news break has been confirmed. It was way back in July that we told you that Glenmark Pharma, which is controlled by the Saldana family, is looking to divest their stake in their unit. That's Glenmark Life Sciences. And now the news is official. The company said that it will sell 75% stake in the unit to Nirma for 615 rupees per share. Let's find out a little bit more about the contours of this deal and hear it out then from the Glenmark Chairman Managing Director, Glenn Saldana, saying that this deal helps both the companies to achieve their long-term goals.
The purpose of doing this transaction was purely because of divergent business models, right? GPL going in a different direction, right, which is more to move up the value chain and develop a branded business, and GLS going into scaling APIs and developing a CDMO model. So divergent business models is what drove us to look at this transaction, right? So that's the first point. The second point is, clearly if you look at, the way forward, a strategic partner is always preferable, right? Because they bring a lot of stability, they bring a lot of growth. Their outlook is more to grow the business as opposed to squeeze out costs, right? And it's much more longer term, right? So strategic partners are always preferable. They take a long-term view on the business. They are growth-oriented. They are, employee-oriented. So always preferable compared to private equity, right? I mean, that's just our view. So from that perspective, Nirma was a perfect fit, right, for this transaction, right?
Okay, and remember, we at ET Now were the first to tell you that this deal is happening. Let me take it across to my colleague Shrishti Sharma and try and understand the contours of this deal and what it means for Glenmark going forward.
Well, yes, the deal is finally through, where Nirma has gone ahead to buy 75% stake in Glenmark Life Sciences at an equity valuation of 7,535 crores. And finally, Glenmark Pharma has come in out of Glenmark Life Sciences, but they'll continue to hold around 7.8% stake into the company. This is definitely a positive for Glenmark Pharma. Why so? Because the company says that going ahead with all the money, that around 5,651 crores they will be receiving, they're going to be utilizing money to pay off their debt, and post this transaction their balance sheet will actually be net cash positive. Other than that, the key to note is the valuation, because this deal has come in at a valuation of 3.5 times EV by sales. We are taking this matrix because of the fact that Glenmark Life Sciences margins have been quite higher, and in comparison to this, if we see other pharma API companies valuations, then that is actually been lower. So quite an attractive valuation. 11 times is what the EV by EBITDA valuation is stacking up. And if we talk about some of the other internals, then 615 rupees a piece is the share price that has been decided. So Nirma will go ahead with an open offer to seal this particular deal. Now, when it comes to guidance by the company, then Glenmark Life Sciences have already guided for a growth of in the mid-teens growth and a stable EBITDA margin for FY24. They already have CAPEX plans, and in the new promoter, if we see their experience in the pharma space, so they also have a group healthcare subsidiary named AccuLife Healthcare. And recently, they've gone ahead to acquire another pharma company named Stericon Pharma. So they have been looking to expand in the healthcare space, and Glenmark Life Sciences is the latest addition to their portfolio, and definitely a big one.
Sandeep Sabharwal joins us. Good morning. How are we doing, Sandeep?
All good.
By the way, that there is a ladder there, there is a rope there in case you want to climb up the wall and hop to a studio now. I just checked in the morning.
I'll try in the evening and see how it goes.
Do you think, let's understand the implications of the news for the bond market, because we are looking at serious inflows which would come to the Indian bond market now after this entire bond inclusion by JP Morgan. How big is it this? How large is this? And is this something which will have very positive ramifications?
There's no doubt it's a very positive news flow, simply because of the fact that it brings in passive money, which has to come in, so which is not discretionary. So $30 to $35 billion, depending on the size of the overall funds at that time, have to come in over a 12-month period into India starting June 2024. So you can estimate around $2.5 billion or $3 billion per month till India reaches its full allocation. And this has happened without India giving up any of the tax concessions which were being asked for a long time. So to that extent, it's even more positive that without giving any concessions, we've been able to come into the bond index. Now, what it does is it does very significant things, because the net government borrowing this year is estimated to be around 11 lakh crores. So a $35 billion inflow implies around 30% of that. 30% of net government borrowings just come in through passive flows next year. So it creates a lot of positivity in terms of crowding out of private investment goes away. It's positive for the rupee because with the current account deficit of, I think it's estimated $80 billion, of $30 billion inflow on that is a very large amount. So it will help the rupee, it will keep the bond yields entrenched. Now, we shouldn't expect too much rally in the bonds on this news because one, the bonds already were doing decently relative to what's happening globally. And secondly, the inflationary scare has not gone away fully, given where crude, etc. is. So I think bonds might remain stable. But given that our gap in bond yields with the US has narrowed so much, I don't think people should be expecting that bonds will start rallying immediately.
But Sandeep, what we understand is that this is just the JP Morgan index, two more indices. And you add all three of them together, we are looking at about 400 to about 500 billion inflow possibly coming into Indian market in next 12 to 24 months after this entire process starts. That is a lot of money, my friend.
Yeah, but I think this was the major one. So what will happen to the other ones? What are the sizes? I'm not so aware, but the JP Morgan index was always the most talked of and the biggest one. So I think that's where, so I don't think we should be preempting any more inflows at this stage. They could be because as India gets tracked more globally, then there could be some more active funds which could come in X of passive. So I think there are a lot of factors behind it, but at this point of time, what has happened is a very big positive for us economically, especially at a time where global liquidity is tightening, will continue to tighten over the next 1.5 years. And in that context, getting passive inflows of such huge magnitude is a positive for the economy as well as domestic assets.
Ajay, let's look at the 10-year paper here. I know it's equity market focus channel, but we're discussing a lot of bond, impact here. I just want to look at the, 10-year paper yesterday. Even though globally the 10-year yield have shot up, in India the bond yield, despite the Fed, has not really gone higher. That is something which I just want to bring out in terms of totality. How the large difference now clearly seems to be emerging. It's not something which is going to last for a very extended period of time because bond markets are much more sensitive to what happens to global rates. And the underlying anchor there is Fed. But I just want to make this point here. 7.2 is where the 10-year paper yesterday closed. It'll open in about 20 minutes from now. Okay, Sandeep, let's look at the market now. Just when it appeared that it was set, on your marks, get set, go for the bulls, because Bank Nifty had also gained some elevation, HDFC Bank had stabilized, Reliance had stabilized, Nifty had gone past 20,000. Looks like we've hit a pause button again.
Yeah, there should be a pause simply because of again, it's a question of the way interest rates are positioned globally, the way 10-year bonds have moved in the US, and what it does to equity valuations as a discounting rate. So I think October, November, we should still be careful about what's going to happen globally vis-a-vis equity markets. The rally has been very significant. Like in India, Nifty rallied almost 20%, mid caps rallied 35%. So it's natural for some gains to be given up. And I think we need to be aware of that and also be ready for that. So I would still think that there should be some more correction in the next 2 months before markets stabilize.
Kunal, Union Bank, IOB, Central Bank. I'm using that as a cluster because that's where I think the fall from the day's high yesterday was 5 to 10%. Would you buy that space or would you avoid that space or would you go short on that space? Only small tier PSU banks.
I would avoid the space and
you will not go short.
No, not go short
Why?
into this stock because they are very high beta in nature. So what you're looking at for is 5% returns, but for that you'll have to compensate with a 5% drop. Now, just as an example, yesterday, I think if I'm not wrong, many of the PSU banking stocks in the first half an hour, first 1 hour yesterday, they were actually up, some 4-5%, and I think most of these stocks, which you alluded, they were up 4-5%. But then on the in the second half, when the market selling accentuated, I think that's where we saw these stocks reversing their course and closing into the negative territory. I would probably sense that shorting these stocks at current levels not be a good risk reward point, but yes, booking profits over here or maybe avoiding to go longs could be a better strategy. I also believe that possibly the likes of Bank of Baroda, SBI, etc., the larger cap names on the PSU banking stocks, they could actually start to perform pretty well. And I think it makes sense to make that switch from these smaller cap 2-digit PSU names towards these formidable ones.
Just looking at the fall that one has seen in the railway stocks as well, and from the recent highs, and IRCON, RVNL, both have fallen about 23 to 20% apiece. Titagarh Wagons is down about 9%. IRFC is down about almost 20% or so. Sandeep, you think time to buy these railway stocks in case you've been completely out of this sector, or do you think they'll fall a lot more from here because the run-up also has been that steep?
Yeah, I think some will fall much more, some will fall a little bit more. So depending on the fundamentals, most of the PSU railway stocks, actually most of the people don't even know why they are buying. So they're just buying because they're going up. So I think on the other side also the same thing happens. So I think there'll be more correction because it's all over social media. Everyone has bought into it for short-term gains, and then whenever the market reverses, the short-term investors, etc. move out. But the longer-term story is still good. So I think if we get them at better valuation, we could look at buying. But we need to be concerned that many of these stocks have gone up 5 to 10 times. Also, some of the some we were lucky to buy in last year at 100. It went up to 800, so I'm not a buyer at these prices.
Kush, if I could come to you, right, do you see these railway stocks fall a lot more from here? I don't know how many you track from the list, but maybe RVNL, Titagarh, IRCTC, the more liquid names.
The names actually that you mentioned, despite the kind of fall that we've seen, have actually sort of gone, very negative on the charts yet. In fact, most of these stocks are still holding above their 20-day moving average. Some of them have just come to the levels from where they just gave a breakout, about 10-15 days ago. So not too bearish on them, but just the fact that, they've been holding on to these, key levels is the fact that there is still some strength left in them. Although given the steep fall, the steep rise first and then the steep fall, the volatility is something that one must learn to handle. So if you can handle this kind of volatility, just wait for some of these names to settle down. The likes of RVNL, even Titagarh Wagon for that matter. Just wait for them to settle down. They might give you a second round of opportunity, at some of these critical support zones. But again, I'm not buying the dip. I just wait for them to settle in first, and then I will look for some buying opportunities in both these names. In fact, RVNL and Titagarh Wagon both, from a near-term perspective.
Individual names as well on the brokerage radar. For instance, you've got United Spirits on Macquarie's radar, where they've got an underperform rating, talking about how there could be some sort of a consolidated EBITDA that will be in tandem with the standalone EBITDA due to the impact of IPL. Delivery as well is what CLSA is getting a buy rating on, with a 550 rupee target price, saying that it has perhaps the employee benefit cost is higher as compared to some of its peers. Let's get in a view then, Sandeep, on some of these stocks within the the new age tech space, the likes of a Delivery, a Nykaa, or Zomato for that matter. Would your thoughts remain the same?
Yeah, so many of these stocks rallied in tandem with the Nasdaq because there's a very high correlation out there. So we are starting to see some corrections start there. So I would think that a follow through will come for many of these stocks also. We have to remember many of these stocks have almost doubled, and many of them have doubled from the bottom. So I think they will also need to give up some gains because the longer term picture for most of them has not really changed so significantly.
Star Health down, ICICI Prudential down, Metropolis Healthcare down. Sandeep, the insurance space has not really lived up to its expectations, right? I mean, first there was this COVID adjustment, then there was a drop, then there was a change in terms of government policy, in terms of taxation. But even though numbers have stabilized, that's what I look at it in terms of the monthly data, what comes out. None of the insurance stocks have regained the glory days.
Yeah, and I think they are unlikely to, because it was when the initial buying happened, and a lot of people thought that it will be a great sector for the future. But what we've seen is that in terms of delivery, in terms of what their profitability ratios are, in terms of the sheer volatility of their performance, it's so high that it's very tough to make a prediction on future direction. Now, the comeback after the shocker which came in the budget has been pretty decent. And that's also reflected in the way the stocks have bounced back from the bottom. Many of them have rallied in 30-40% from their bottoms. But at these levels, they are fairly valued. No significant upside seen.
Cheap in this market, Sandeep, then? I mean, what is cheap and where there is value, or where even value is not there, earning visibility is so strong that one can consider it?
I think nothing is very cheap now. And to that extent, that's the reason why we need to wait for some froth to go away before significant buying can be done. And the only stock which we have actually bought last 2 weeks has been that we have been continuously accumulating Voltas, because I think that's where I still see that the perception is much more negative than what the company might actually be able to deliver.
Okay, I just missed that, Mark. You bought into Voltas 2 weeks ago.
Yeah, we've been continuously accumulating whenever there's a dip.
Okay. Any bet on what could be a festival season surprise this time? I mean, which category which you think would surprise us? Like luxury surprised us a year ago. Cars, SUV surprised us 6 months ago. Any category which you're betting on?
So I think retail and consumer is something we need to watch out for, because those stocks are beaten down sectors. And if there is a revival in consumer demand, then I think there could be a rally in those categories. So I think that's where those could be categories we should watch out for as we go into the festival season.
That's a very large pool, Sandeep. I mean, it follows anywhere from a trend to a landmark to a ethos to auto companies to even a Havells.
Yeah, so where the growth uptick will happen, that's something we need to see. But I think in terms of what's actually very beaten down is are all the retail stocks, like something like Aditya Birla Retail. It's beaten down very significantly because of, one, the overall slowdown in the retail space, and secondly, because of some action they have also done. So I think, and their profits are highly leveraged operationally to top line growth. So if we see a revival in growth, then bottom line improvements can be significant. And it's, I think, 35-40% off the top. So I think that could be one stock to look out for.
This year alone, it's fallen about almost 25%. Kunal, you track ABFRL closely, right, on the charts? Do you see any revival or recovery anytime soon?
There was a decent revival, I think, for the stock from 180-82 mark, I think 5-6 months back, March, April 2023. I think from there, the stock had actually risen up to 225 plus levels. The concern with the charts for ABFRL is that the stock has reached its 200-day moving average, but even failed to surpass about those levels, let alone close above that 200 DMA. And from there, 225 odd mark, the stock has reversed back again. So which means that the stock would take at least another couple of attempts before it tries to confirm a breakout. So it's an evolving chart, but I think in terms of a breakout, the confirmation is yet to happen for ABFRL.
But ultimately, you have to go back to HDFC Bank. Whichever way we twist and turn, it is HDFC Bank that sumo which took the markets down. Shivangi, where is HDFC Bank headed? Do you think 2-3 days of decline has pushed HDFC Bank into a phase of deep slumber?
Good morning, Nikunj. Thank you for having me. So we've seen that, the broader market was quite a lot dampened by this, selling in this stock. And we've seen that the support is near 1530 zones and the stock is, heading towards it. So 1530 would be an important level to watch out for, as it was the previous, key support zones. Earlier, it used to be a resistance zone as well. So this is a key reversal area. Upside remains a little bit capped. I'm seeing a little bit pause in the momentum in the heavyweight banking stocks, but the PSU and the other names in the banking sector are looking quite positive.
Right. Just looking at some of the other pockets, and of course, we've been highlighting how it almost looks like a synchronized heavyweight sell-off. And we were discussing this with Sandeep as well just last afternoon, how it all started off with HDFC Bank. Yesterday, you had an M&M, ICICI Bank, SBI, all fall under their own weight, Kotak, Tata Motors, IndusInd Bank as well. But Kunal, how much more will these private banking marquee names fall? The likes of ICICI Bank, IndusInd, and I would include even SBI in the PSB pack, or for that matter, even HDFC Bank, given the kind of high weightage and impact it has on the index.
See, I think I'll probably look at this into two parts. One is, HDFC Bank was one of the weaker stocks already over the last 9 months, 1 year, 2 years, given the kind of matrix and the underperformance the stock had shown with respect to the other private sector names. And now the stock, after that news flow, I think, and after that gap down, has dated the short-term charts for itself, which means that the selling pressure should at least continue for another couple of days, couple of weeks for HDFC Bank. I think 1500 or slightly below those levels could be the first level of support for HDFC Bank. But looking at the selling 2 days back for the stock, I would probably expect that those levels could also be taken out on the downside. Now the concern which is happening is, as you rightly mentioned, that the selling is spreading across most of the other large cap names. Like yesterday, we saw ICICI Bank selling, going into selling pressure. M&M, which apparently has been one of the more stronger and the formidable charts, that also has done, or rather that also stock corrected yesterday. But I think on the other hand, the likes of SBI, for example, I would still believe that that's a stock which could still hold on to that 600 mark, 600 range as a pivot. So I expect possibly the private sector banks to maybe show one more round of selling pressure. But I think the PSU banking major like SBI and other sectors like M&M, etc., these stocks could still hold on to their previous pivot point supports.
Okay. The Bank Nifty, in a sense, has really been this index where you expected the beginning of the year serious outperformance that has not translated into a reality. Now, what's interesting is that yesterday, which is Thursday, IT stocks, which after the Fed commentary where they're bullish on the US GDP growth, they should have rallied. But some of the IT stocks have not really chipped in very, very smartly. If one looks at TCS, these are yesterday's rates. They did not participate with the same force with they should have when you normally hear this kind of constructive commentary from the US Fed about the US GDP growth. Shivangi, will it be back to the trade what we've seen for the better part of this year, avoid banks, back to IT?
Somewhere or the other, heavyweight IT stocks have, somewhere stabilized, I may say. But then again, the mid-cap names are looking quite, interesting. So some of the names which are on my radar is Bsoft, which is again started to gain some momentum. Now, the thing with IT stock is that it needs a little bit of push from the index. And since the index is in broader pressure right now, so somewhere or the other, we can see that mid-cap IT will start gaining momentum once the Nifty, starts stabilizing. Now we've seen a 500-point correction in the last 3 days. So still it remains below 19,888. We could see some more declines, but then again, this would be an important level or juncture to watch out for the index as well.
All right. Meantime, let's also get in a take then on the charts. Some of these large cap counters as well, the likes that have been coming under a bit of pressure. And Shivangi, wanted to understand how you're looking at the bank index as well as in particular the likes of ICICI Bank, Kotak as well as an HDFC Bank on the charts.
So talking about Bank Nifty, we've seen that there has been stellar underperformance from the last 3 days, and the index has corrected from 46,300 to 44,600 levels. So steep correction can be seen, and it is now trading below its 50 exponential moving average, which is a slight bit of concerning thing on the charts. On the weekly frame as well, we've seen that it has given up the last 2 weeks gains. So somewhere or the other, we may see weakness towards 44,250 levels, and the hurdles are placed at 44,800 zones. Now, looking at the heavyweights bank, if we talk about HDFC Bank or maybe ICICI Bank as well, for that matter, these stocks are looking out for some sort of a pause and negative stance over here. But then again, the PSU names and the other small banking names are looking quite attractive at these levels.
All right, fair enough. That's a view coming in on some of the large cap banking stocks. Also wanted to understand, Sandeep, from you what the outlook is when it comes to, some of the auto names. Of course, we had started off the year with a very fiery run-up within the auto stocks. Lots of new launches, focus on EV. Are you very selective when it comes to the auto space?
See, auto broadly, many stocks look still to be good ones for the long term. So right from Mahindra, Tata Motors, Maruti to Bajaj Auto, I think all of them should do well longer term. But when there's an overall correction in the markets, they will also correct. So I think as we move forward in October, November, I think I would actually be looking to buy them rather than being a seller at these prices.
All right, that's the view coming in on the entire auto space. In the meantime, interesting as well to just map out the kind of move that we've seen in some of these PSU banking stocks. Of course, we've been talking about them as well, but the kind of delivery that we've witnessed, the 10-day average as well for the names like an SBI, a BOB, Canara, as well as Central Bank. And of course, in yesterday's trading session, you did see that move on the downside. That, by the way, is the currency as well. And you're seeing some sort of a retreat after those lows, and that's largely on the back of the JP Morgan news as well, with the bond inclusion for India. A quick take then, Kunal, on the currency. Are you expecting a further retreat from the 83 mark?
I think 83 is a crucial level for the the rupee, because I think if you manage to come back below that 83 levels in terms of the levels as such, then I think we could probably get into a reversal mode for the rupee. But I think if you hold on about that 83 mark, then I think as I said, that possibly 83.25, 83.5, these could be the two levels which one could probably expect over the very near term.
Maybe if we had further cues coming in from across the globe, that would a little bit more supportive. But yes, there you have it. The rupee has breached that mark of about 83. And so some more resilience coming in at about 82.82 to the greenback. Let's check in on what the pre-open rates as well are indicating this morning. And despite what the rest of the globe threw up for now, at least it's a mild take of green. That's what the pre-open rates are at about 19,751 on the Nifty. What about the mid-cap trading calls from our chartists? What is it that they're picking out? Shivangi, let's get in your take.
So on my radar is Indian Bank. We've seen that this stock is holding on to its higher levels despite the broader weakness in the market. Now we've seen that it has given a sort of a pole and flag pattern formation on the weekly frame, and there has been good amount of volumes being added from the last 3-4 sessions. So this stock is looking quite positive amongst the broader market weakness, and recommending a buy here with the target of 420 levels and a stop near 397 zones.
All right, okay, just let's quickly get in Kunal's mid-cap call. Kunal?
So there'll be a sell on IGL, stock forming a bearish head and shoulder pattern, 444 as a target, stop loss at 470.
All right, now let's mark the Indian rupee. The big story this Friday morning is that the JP Morgan bond index has included Indian bonds. Now, what would be the implications and ramifications of this? First, let's understand. Very simple. That means more flow will come into the Indian bond market via global investors. If that happens, more flow means that bond yields, theoretically, they should come down. If bond yields, they theoretically come down and flows are more, that surely means the cost of borrowing in the system goes down. If the cost of the borrowing in the system goes down, it automatically will have impact on the government finances, and especially in this case, the fiscal deficit. Also, if fresh flows come into India, it will also have an impact in terms of where the rupee would move. Now, when it comes to rupee, we can argue that whether the Reserve Bank of India will intervene or not. but they will certainly like to curb the volatility. But one thing is evident, that this is a big door which was shut and that gate has opened. And when that gate has opened, flows, they come into the bond market. And the bond markets, they continue to attract this kind of inflow. The differential yield between the developed market and in the Indian market will reduce. And structurally, this will continue to bring the cost of borrowing for Government of India down. So it will have short-term, medium-term and long-term implications. Now what we understand is that this is just one of the index, which is the big index. There are two more indices which also could, two more indices which perhaps could also be coming out with same kind of a impact. If that happens, then we are looking at flows north of $300 to $400 billion starting June 2024, which would be staggered. Markets may want to price that in the run up to the inclusion, but the bottom line here is that this is something which is path breaking, permanent, and full marks to the government in terms of the way they have really managed to convince global financial firms in this case to accept and to accept the facts and to really make and give them a very important entry point, because it involved a lot of back and forth kind of a movement. The 10-year yields have already fallen by 7 bips, and the reaction is not going to be immediate. It's going to be spread across, because the inclusion will start from June 2024. But in terms of a move, in terms of an impact, in terms of a change, I think this is something which is going to have very far-reaching and very crucial and positive ramifications.
Yes, indeed, and that already is playing out in the movement of the bond yield as well as the currency. Let's move right back on to some stock-specific news. And what's the khabar on D Street today? Well, Nalco is going to be in the spotlight as the new refinery completion is apparently seeing some delays. Let's understand how long this is expected to last. How is this going to impact the stock? We've got Sharad here with a roundup. Sharad, morning.
Well, yes, in focus we are having Nalco, and from the buzz we are getting is that the completion of the 1 million tons per annum alumina refinery, that is expected to have a delay, and this delay is expected to go as long as 2 years. Now the important part is that the free cash flow of the company itself, that has actually turned negative in FY23. Also roughly you could say 300 crores of negative cash flows have been coming, and this is coming in after 2 years of positive cash flows, and that is what the street is also cautious about. Also apart from this, there are 3 important reasons which the street is actually cautious on the stock, and these includes the growth capex, the softer aluminium prices, and in the surplus market there is still a weaker demand. Now looking at the overall 12-month target price for Nalco, that is coming at roughly rupees 99 per share. This is as per the Bloomberg consensus estimates, and also recent highs, the stock has also corrected by almost 10%. So in focus would be Nalco, especially on the alumina refineries completion, which is expected to be delayed going ahead.
Let's move right on. Thanks very much, Sharad, for those details and get you some more news and updates. And as the diplomatic row between India and Canada escalates, the government has suspended the visa processing services in Canada, saying that Indian diplomats were unable to perform their duties because of threats from Khalistan forces. India has also asked Ottawa to reduce its diplomatic strength in the country. Meanwhile, the landmark Women's Reservation Bill is set to provide 33% reservation to women in the Lok Sabha and the state assemblies, and that was passed unanimously in the Rajya Sabha after having been cleared in the Lok Sabha. None of the MPs in the upper house voted against the bill. Meantime, the Prime Minister will virtually inaugurate 9 new Vande Bharat Express trains on the 24th of September. With this new addition, the total number of Vande Bharat trains in India will reach 34. According to reports, the semi-high-speed trains have 8 coaches each, and these trains will start operating starting Sunday. And to the world of sport, India will be taking on Australia in a 3-match ODI series starting today. This ODI series is vital for India's preparations for the World Cup, which is set to begin from the 5th of October. Spinner R. Ashwin has been included in the squad, while Rohit Sharma and Virat Kohli will miss the first 2 ODIs, which will be led by KL Rahul. And all you Apple fans, the wait is finally over. The Apple iPhone 15 series is available to buy from today. This launch has a lot of significance in the country. It marks the first sales of the Made in India Apple iPhones, and it's quite similar to what we've seen in the Apple stores as well across the globe. As you can see on your screens, enthusiasts in Mumbai and Delhi, they've lined up outside the store in the wee hours to purchase their latest devices. All right, let's get a move on then and tell you a little bit more about source-based news. We understand that the Finance Ministry has approved the Oil Ministry's proposal to provide 30,000 crore rupees financial aid to the OMCs. Let's understand a little bit more. Prakash, my colleague, joins in with all the details. Prakash?
Yes, an important development coming in for oil marketing companies, as we are learning from our sources, that the government may provide financial support of rupees 30,000 crore to the oil marketing companies very soon. We are given to understand that the Expenditure Finance Committee of the Finance Ministry has given its nod on this proposal which was sent by Oil Ministry. We are also learning from our sources that the Oil Ministry is now seeking final approval from the Union Cabinet on this proposal. As you are aware that the government has already announced rupees 30,000 crore as a financial support to the oil marketing companies for green infra projects in the budget. But the government is not in favor to provide this amount to the companies by way of subsidy. In fact, it is seeking equity in oil marketing companies in return for funding. Oil Ministry has already instructed companies like IOCL and BPCL to launch right issue. However, HPCL will issue preferential share to the government in return for funding. So it's a big development coming in. We are also learning from our sources that oil marketing companies could be provided financial support of rupees 30,000 crore by next month, which is a big relief expected for the companies, especially at a time when crude oil prices have again started going up, and so as they're under recovery. So financial support of rupees 30,000 crore at this point of time could be considered as a big relief for the oil marketing companies in order to cover their previous losses.
Thanks very much, Prakash, for giving us those details. That is the Finance Ministry approving the Oil Ministry's proposal. Well, let's find out what the index calls are. Just about a few minutes to go for the markets to open for trade. And it's a divergent recommendation from three of our technical chartists. No trade. Remember, that's what Kunal flagged off this morning. Kush believes that you can hold. And a sell on rise is the advice that Shivangi is giving. This is for the Nifty Bank as well. Do remember, 3 straight days on the trot that we've seen selling pressure for the frontline indices. It's been largely dragged down by banks because the underperformance there has been evident, particularly in some of the large cap names.